This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, as always, and today we are very pleased to welcome on an interesting guest. He is Mark Miller, the CEO of Hilton Wealth and Tax Advisory Service, and we're going to be discussing some stuff today that is near and dear to my heart. If you've listened to this podcast for any appreciable amount of time, you know that a few of my big passion points are private investments, private securities, real estate, and we're going to be covering the first portion of that in being private equities and kind of how they can play into the broader scope of people's portfolios and really some of the benefits that are offered in the private space that many people are missing in the traditional public sectors, as well as some very interesting tax planning strategies that most people may not necessarily be aware of that, typically were being used by high net worth, $10+ million wage earners or net value individuals that really kind of have made their way into the more common populace and how people can take advantage of these strategies. So without further ado, Mark, if you wouldn't mind giving us a little bit of introduction to yourself, kind of how your professional trajectory led you to being the CEO of the Hilton family office and what you're kind of doing now, and we'll dig into the topics at hand. So thank you very much for being on with us today.
Well, thank you, Alex. I appreciate you having me for sure. So I've been working with the Hiltons for several years, doing a lot of different deals, various things. They've made me money, I've made them money. And a few years back, I got with Brad Hilton, who is a grandson of Conrad Hilton, and we decided to do a spinoff of the Hilton family office. I assume a lot of your listeners know what a family office is, but for those that don't, it's when a bunch of wealthy people get together. They kind of pool their resources, and kind of pool their knowledge of specialized kind of advanced wealth planning strategies, and they all kind of play off of each other. And they also save a lot of money by having kind of one office to administer it for many families. So Brad and I came up with the concept, but we said, how can we bring some of these more advanced strategies more down to kind of the average investor? And you don't have to have 20 or 30 or 40 or $50 million to plug in. And that's where Hilton Tax and Wealth Advisors came in. And I'm the CEO of that company. Brad is my main partner. And basically, we just help folks. First of all, one of the biggest things we do is come in because the biggest expense that anyone will have, super wealthy or not, the biggest expense they'll have in their lifetime is taxes. And the Hiltons are some of the best in the industry at tax mitigation. So we take some of these advanced tax mitigation strategies, we design formalized tax plans, generally save folks 50% on their taxes the first year. And then the book that I just came out with called The Tax-Free Business Owner, and it goes beyond business owners too, but getting you ultimately working towards getting you to, like the wealthy are, in the zero tax bracket. That's ultimately what we're working with on the tax side. And then we plug our clients into advanced tax strategies, advanced wealth building strategies like alternative assets, private equity, things of that nature that they wouldn't normally have access to other than being part of the Hilton Financial Network.
Awesome. Well, thank you very much for that background. If you don't mind, kind of how did you get to be, where did your earlier career path take you? Most people don't. I have a few colleagues that kind of started their careers pretty early on at family offices, but most of the time it's not the first landing spot for a lot of people. So I'm always interested to know, especially for my peers in finance, kind of what led you to be in the position you're in today? Were you sitting on a trading desk? Did you have a career on Wall Street? Where did your genesis come from?
I've been in the industry a long time, straight out of college. I went to work for IDS American Express, which doesn't necessarily totally exist in that form, but I cut my teeth there, then worked for some local brokerage firms, and ultimately I started again. And I also then got into book publishing. I've written several nationally published books, a couple bestsellers, and had a internationally published newsletter on personal finances in the 90s, and then ultimately launched my own firm in the late 90s. And just over time, if you were to say, what do we do? Primarily, we work mostly with business owners. I'm a business financial consultant where we help people, business owners in every aspect of building their businesses, building their wealth, just helping them get wealthy faster. So the genesis of how I got into it all was once I started my own firm, I got a lot of contacts with trust companies, kind of advanced planning, started to get kind of on the institutional side of the business and making contacts there. Ultimately met the Hiltons and then have worked with the Hilton family for years that have just taught me numerous things about how the wealthiest of the wealthiest invest. As a matter of fact, I'm about to launch, I'm just around the corner from launching a book called Hilton Wealth that's going to go in depth, not just how they got wealthy from Hilton hotels, but how the Hiltons invest in a lot of other things and how they maintain their generational wealth over time.
Yeah, that's something I kind of echo from my own personal experience. Granted, on a significantly shorter spectrum than how much experience you've had in finance, but some of the more interesting things that I've learned, and it's not just things that apply to, again, the that 0.1 percentage of the wealth spectrum in the United States, is the things that I've learned and see that from the family offices specifically that I work with are fascinating, and it's that creative thinking that. Sometimes afforded to people that have enough money to, go out and be creative and not afraid to lose it, but really kind of can then in turn open the doors to show, hey, these are viable options. These are things that can really be useful and distilled down into something that can be achieved by, again, you have to have some money to invest. You got to buy the lottery ticket at one point.
Yes.
But again, to that point of being accessible to the broader spectrum of the masses. And again, that's really kind of what I'm excited to dig into you with today. So let's kind of maybe start with the tax part, because everyone knows, and especially in my industry of the alternative asset and retirement plan space, is that it's not how much you make. You can make as much money as you want, but if you're taxed at 70%, well, you only made 30% spread, whatever you actually made. It's what you take home at the end of the day. And it's something I'm passionate about helping people to try to, see and do, and especially with yourself as well. So, with it, when it comes to that, it's this extremely loaded question. And I know before saying this, but kind of where to start. What are some of your kind of
loaded questions? No loaded question. It's fine.
Where's it's always a hard one to say, hey, kind of where to start, but it's in the context of kind of what you do and your passion points and what you're really examining right now. What are some of the newer strategies or things that maybe not necessarily new, but are being re-implemented that can be a very good use to people, kind of where they start and where they end?
Well, Hilton, in the Hilton Financial Network, we have 130 plus tax strategies. Now, a lot of those are, bulwark strategies that are just deeper in the code. You'll never get them. You'll never see them from your CPA just because they don't get deep into the codes. They're generally on the surface. Make sure that you're doing everything you need to do in your tax preparation and getting your interest deductions on your home mortgage, things like that. We go a little deeper, a deeper dive into the strategies. For instance, we'll look at fringe benefits. What can you do related to your company fringe benefits? And the whole concept is looking at what we normally spend money on, but how can we shift those and make those tax deductible in various ways? Generally, we want to set up some, if you don't already have a business or some kind of entity set up. We want to set up an entity because then we can use that entity, whether it's just an LLC or something like that, to then leverage strategies and leverage some business strategies. That's where we're going to get a good chunk of kind of those bulwark strategies that can save you quite a bit to begin with. And we're focused on saving people approximately about 50% their first year. But then we move to some more advanced strategies. I can just give you some general ideas we have. We call them one-off strategies, excuse me, where you can invest in different charitable strategies, mining, oil and gas, things like this. And more advanced, you hear those things and you say, well, I may have already done that or done REITs or something, but then we'll add a new component. And we often have some proprietary strategies that are attached to kind of more one-off strategies that people may have done before. I'll just give you an example, just being very straight right now. I'm about to head to the Cannes Film Festival. Me and my clients, several of our clients are executive producers of several large movies that are coming out. And we often people hear about these state tax film credits. And that's what everybody knows. And that's what maybe CPAs kind of focus on. But there's also federal tax credits that often will give you 4 or 5 times to 1 of what you invest in deductions in credits on your tax return. So that's just one example. That's one of many types. And then we'll invest in rare minerals that we get charitable deductions for, sometimes 3 to 4 to 5 to 6 to 1. Things of this nature. And again, I don't want to go into and delve into the nature of all this because it really depends on individuals' specific situations. And everyone, we design their own specific, unique, formalized tax plan. Get to that 50% as close as we can the first year, and then we start working with them to gradually. It takes time, and we don't guarantee that we're going to get everybody to the zero tax bracket, but usually if we work with them for 3 or 4 years, we get most of our clients to a zero tax bracket. Now, a lot of people think that sounds too good to be true, but they don't understand that the wealthiest of the wealthy barely pay any taxes at all. And most people, they kind of know that, but then they think, well, that's for the wealthy. I can't do that. Well, folks, more average investors can do that too if they have the right access to the right strategies.
Sure. So a few things that I kind of took away from what you were saying is there's kind of 3 big funnels that you're looking at. One being fringe benefits, the other being kind of investment-born deductions and write-offs, and the third being some type of charitable strategy. I think the ones that probably resonate the most with people would be the fringe benefit aspect, because a lot of people that listen to the show and a lot of my clients are either have some portion of self-employed income, they kind of dual income, maybe work a W-2, but also do consulting or some management stuff, or they are, self-employed individuals or small business owners. So the fringe benefit thing, I think, really kind of hits, to a core of a lot of what people, maybe tune in for, and a lot of our broader audience as well. And the investment one, I think, is kind of easy to dive into as well. The charitable aspect, and correct me if I'm wrong, but is the charitable aspect maybe more of, again, the higher net worth people see a lot more benefit from that, or do they all kind of have a blended strategy?
Because we have 10 different proprietary strategies in the charitable arena, and it's not just obviously itemized deductions and getting a charitable deduction. There's structured strategies for folks that even let's say, and most of the folks, we want to work with, and we're most efficient on tax planning with folks that are making 250, 500,000 and above. Okay. So if you're only making 100, there's not a whole lot we could do with you, obviously. But we can layer these strategies in. And I want to be clear that I kind of gave a few examples. For instance, in that fringe benefit arena, there's some basic ones that people might know already, but there's 14 other strategies in the fringe benefit area that, again, are deep in the codes. And that's the difference between tax planning and tax compliance or preparation. And folks are welcome to get a copy of my book. They can go to hiltonwealth.com, get a complimentary copy of the book. And we dive into the different components with 130 different strategies. There's going to be some strategies in some area that are going to be applicable to your situation.
Sure.
But the key is in understanding what we're trying to accomplish and what we're excited about, and you kind of mentioned it earlier, is trying to get these more advanced strategies more down to the masses. Now, again, we're not talking about people that make $50,000 a year. That's the masses. But we're talking about kind of the fluent masses that are in that, $1 million, $2-3 million net worth range that just don't have access to these type of things. And really, what Brad and I are mostly excited about is really giving access and showing people how powerful these strategies are, and they wouldn't have access otherwise.
No, absolutely. And I think, especially for a lot of, small business owners and, people in the category of, people that listen to the show, it's not hard to, especially if you have been investing or have assets to really kind of, it's like a lot of people maybe necessarily don't calculate their net worth too terribly often,
Mhm.
unless you're maybe a nerd like me and are like, hey, I wonder what my net worth is and start going through everything and calculating it. But, it's not that necessarily unattainable, especially with the appreciation of so many capital assets in today's culture that you can kind of hit that mark to where some of these strategies might be very beneficial to you. Now,
Yeah.
I'd like to maybe dig into, again, things that I think, there's so much to unpack here. And like you said, there's hundreds of different ways you can kind of bifurcate some of these different strategies. But looking at the investments and the fringe benefit funnels, if you will, I think probably would ring most true to what people tune into us for. So
Yes.
when you say fringe benefit, let's kind of maybe pick out in your own words what some of those fringe benefits are. I have some in my mind, but I'd rather hear it from you
Yeah.
on when you say that and how they can be, again, high level, like what are they, and then how can they be kind of utilized in a broad tax strategy to reduce
Well,
income?
here's just a small one. People don't know it. Well, a couple things. People don't know it, but again, if they have an entity, they can put their kids to work in their business and get deductions from that. And then ultimately what that does is that pays your kids and then can pay expenses depending on what age they are, pay expenses for schooling, pay their everyday living expenses too. And technically that's, quote, a fringe benefit, a side benefit. It's not just an employee benefit, it's a side benefit. Another thing is too, people don't know, but you can actually reward yourself and reward your like family members that work for you with annual payments in the form. It has to be a tangible asset. We use these. I personally use these as every year. Our family, each of us, that because our kids work for us too, they're in our companies too. They get a certain amount of money that they can spend on somebody else in the family for their Christmas gifts.
Hmm.
And that can be actually tax deductible. Again, I won't go all of the details on how that happens. Don't have enough time here. But that's another example. Again, people don't know about those things, and it's deep in the code. So that's just some fringe benefits, an example of a few fringe benefits that people don't take advantage of, and they definitely can. That just puts money right back into your pocket.
Yeah, kind of to distill that down, basically, you can, have your Christmas gifts and your family be tax write-offs.
Yeah,
Again,
absolutely.
that's a really cool aspect to kind of look at, and that's why it's important to talk to people such as yourself, where you can say, hey, look, like, the ultimate goal here is to, mitigate and reduce taxation. And, on face value, said, oh yeah, you can write off your Christmas gifts. It's like, most people would balk and roll their eyes at it. But, when you
Yeah, absolutely.
when you take that
You have to know
analytical,
what you're doing, and you have
yeah,
to know the strategies. And that's the problem with most CPAs. They're tax prepared. They're just advanced tax preparers. Really, they just use advanced versions of TurboTax that generally have like CRMs attached to them so they can keep track of the hundreds of tax returns that they do. And that's where the vast majority, 95% plus of them, stop. And there's 170,000 pages in the tax codes.
Mhm.
So you're telling me that it really only boils down to 3 or 4 things you can do, and most of it really boils down to, hey, put more money in your 401k, or put more money in an IRA or a Roth or something like that, which is great, which is fine, and I'm not. You should do that, but that's usually where it stops. And there's so much more because, after all, and here's what I educate people about: who wrote those tax codes? Most people say, well, the IRS. No, the IRS doesn't write tax code. The legislators write tax codes. And most of those legislators, especially in Washington, are very wealthy individuals. The reason it's 170,000 pages, let's be honest, is so they can save more money on their taxes. Okay. Most people in Congress pay very little in taxes, if nothing at all. The wealthiest to the wealthy generally pay nothing at all. You never hear about it. They keep it kind of hush hush because they don't want the people to think that they're not, quote, participating. But the reality is, time and time again, the courts have told us, even the Supreme Court has told us, we are not required to pay any more taxes than we need to within the law. Okay? So if we're following the codes, we're following all the law, we're being moral, we're being ethical as the Hiltons are, and we are with everything that we do, then if you can zero out your taxes and you're doing that, why wouldn't you do that when it's within the law and the law has consistently said it is within the law?
Yeah, and the other thing I like to, tell people is that, especially to that point, is that, the IRS is not just this, faceless organization. And to your point of, where did they get these tax laws? It's legislatures that write them. There's a human
Yes.
component to this, and
Yeah.
understanding that, that 170,000 plus pages of tax code, there is human interest and humans behind writing this. And if there are pathways that are maybe otherwise not interconnected that you can make connections to, again, in best practice, in an ethical fashion, again, humans wrote this, humans are taking advantage of it. So add the human element into it, get creative, look and see how this stuff can work. And again, make sure you're tax planning and tax preparedness is much different than tax evasion, because that will get you 4 hots and a cot and some state
Yes.
that will get you the state sponsored healthcare that you're not looking for. Put it that way.
Yes, absolutely.
But
There's a legal way and an illegal way to do it.
yeah,
And it, in most people, and some CPAs dive in and they're tax planners, but the vast majority of them, and the big myth that I try to dispel, and we need CPAs, don't get me wrong, because they file our taxes, they dive into a lot of numbers, they do auditing in businesses and all. We need CPAs, okay? I'm not attacking CPAs from that standpoint, but CPAs, people need to understand that their CPA is not their financial guru, okay? Most of them know very little about outside of compliance work because they don't have time to go and learn it all and understand it all. But then somebody calls them up or asks them about a financial matter. Well, they don't want to sound stupid, so they generally give a little platitude on it, and they're if there's anything new or different, their first gut is to just say no, because they don't know enough about it, about so much in the financial world. I don't blame them for saying no, but you need to understand that. The other thing too, we talk about the myths of red flags and things like that. Again, there are a lot of CPAs still out there that say, don't take a home office deduction. It will trigger a red flag. There's 3 distinct ways, technically 4 distinct ways in the tax codes to take home office deductions. And they're all spelled out. If you're within the law, you have all the documentation and you're using the codes properly, then how is that a red flag? Okay. So and you go through this in the book. There's so many myths surrounding taxes, tax planning, how you can save money on your taxes or not. And again, we've learned all of this stuff. I've learned it in other ways too, but a lot of it we've learned from working with the Hiltons, who are considered on the institutional side of the business, practically some of the top tax mitigation people in the entire world.
Yeah, and also understanding, what I like to also tell people is that, don't be afraid to engage and pay for good advice. Me being in the professional realm that I am, just in the last 2 major tax law updates, the Secure Act and the Secure Act 2.0, had almost 700 pages per iteration of that I was the lovely person at our organization that I got to read. And even when you have stuff like that, there's still aspects of both of those bills that haven't even come to fruition in the actual application of the tax code.
Right.
Legislatures write this stuff. It doesn't even go into practice. And understanding, when this stuff can be taken advantage of and how is critically important. The easy example is that the legislatures wrote into effect after tax contributions for employers to SEP and simple IRAs.
Yes.
The problem is that the IRS still hasn't written coding for custodians and financial institutions to offer those plans to people. And we're getting up to 2 years post the legislative signature on that piece of bill, that framework. So again, understanding that the stuff is very fluid, very dynamic, and stuff changes, and understanding how it can be applied is best done, maybe not necessarily with a CPA. Again, CPAs are great. I know CPAs, right?
Yeah,
Again,
sure. And we all do. And there's super smart. I will tell you, the CPA exam is one of the toughest exams that anyone will take to qualify to be in a profession.
yeah, I've taken a few
Extremely,
practice
extremely
tests.
difficult. Real quick story too about paying. How I got into the tax planning arena was interesting story because it was in the early 2000s, and I've always had several companies. I had one company that was making multi-millions of dollars, and I was getting $1 million tax bills, and I had what brought this to mind is I had a friend that actually was a CPA. He had previously been a tax attorney. He scored in the top upper percentile, 1% of all folks that has ever taken the CPA exam. So super smart, super bright. He actually became a mergers and acquisition guy. He introduces me to the CPA, says, this guy's the best in town in Atlanta. You got to go talk to him, all that. He was very impressive, all of that. I got going with him. But as the years went on, I started making more money. And my tax bill, of course, your tax bill goes up exponentially. When you do nothing about it and don't know how to do anything about it, it just explodes. And it's infuriating because you're making all of this money, but then you're gradually paying more and more and more taxes percentage wise. And so I every year I would say to him, isn't there something we can do? Oh, no, you've maxed out your 401k, you've done this and all that. And finally, I just got fed up and I got this giant tax bill, multi-millions. And I said, there's got to be something we can do. And then he started lecturing me on the phone. You don't understand, young man, how fortunate you are. You're in the top 1% of all of this kind of stuff, very condescending. And so I fired him on the spot. I said, I don't want to hear that anymore. And he just kind of gave me the riot act. You don't know who you're firing, yada, yada, yada. So immediately I picked up the phone after I got off with him and I called my buddy and I said, I think you're going to be getting a phone call from your buddy. and I said, and he said to me, he goes, why didn't you tell me you were paying all this money in taxes? And I said, he's one of my best friends. I said, I'm not going to tell you what I'm making and all of that kind of stuff. He goes, I would have gotten you with a tax attorney I know, and we would have, cut your taxes in half or more. So I said, I didn't know that. Well, I go to this guy, $2,000 an hour. Now, this is back in the early 2000s. And I was like, I'm not going to pay that guy $2,000 an hour. He goes, well, let me go to work. Let me show you some things. Showed me how to cut my taxes in half the first year. I cut that check for $2,000 an hour faster than you could even see. And that's how I got introduced. And then over time at the Hiltons and just eventually got to the zero tax bracket and been there ever since. So.
Yeah, and it's always good to kind of talk to people that have practical application of things. From my perspective, I feel like it's always very beneficial. Personally, I self-direct and do these kind of investments that I preach to my clients through my different retirement plans. Talking to people such as yourself that have had practical application in their personal lives, I feel is very beneficial. To one, know that they're not just kind of reading out of a handbook.
Yes.
Granted, you have written a book, so it maybe is not the greatest analogy, but people that have the practical knowledge to even write a book maybe is the better point to make. So to transition a little bit into kind of that second bucket, we got a little bit off on a tangent on the French.
Sure, that's fine.
The investment side of things, this is the Alternative Investment Advantage podcast. So I like to at least steer things into the investment world because that's, a big passion point for me. You had mentioned kind of a lot of different types of assets and, there's as many different tax benefits as the day is long when looking at write-offs from different investments, but you had kind of thrown a few out there, such as, investing in films and some of the interesting stuff. And I'd like to touch on that because that's one that I don't know a whole lot about. I've had some clients go that route, but again, I don't know much about it. Things like oil and gas and different private equities and things like that. So if we can maybe transition a little bit into that and to some of the different distinct and unique opportunities that are afforded to people to help mitigate taxes when it comes to investing.
Yeah. Well, you mentioned the film thing, and that's kind of forefront on our minds because we're going to con and all of that. And but Section 181, which actually has been in the codes for years, And whatever you think of Donald Trump, we can thank him for some kind of unique tax things he did for us in 2017. He reenacted that we're allowed to have a federal film credit. And so that launched us into getting very involved. We've previously been involved with kind of top production companies that the best people in really in the industry are part of. Where I'm from, Atlanta, Georgia, there's an area that we call the Hollywood of the South. Last year that Georgia did about $25 billion. All the Marvel movies are done here. It's really a burgeoning, and it's kind of small right now, believe it or not. It's getting bigger every year. So we have a lot of local clients that get on board with that. And then we can invest in these projects, and then we get these big tax deductions beyond just the kind of state film tax deductions that most people know about. So you're also investing in the film, which is great. You're not just investing to get the deductions, but you get a portion and you get a chunk of the film should the film do really well. Well, we happen to we've just invested in a Mel Gibson production, and we happen to be, hooked up with some very, very large production companies. The Hiltons happen to be where we can actually almost not guarantee, but we know that the track record of these folks, and we know that they make $100-200 million a movie, that type of thing.
Sure. So
that's one cool strategy. But anyway, go ahead.
So when it comes to where the rubber meets the road of the actual tangible investment, because my experience with films has been limited mainly to different debt strategies. But when it's easy to say, hey, invest in this film. It's like, okay, well, if I hand you a check, what am I getting for it? So are these structures mainly based on some type of equitable interest? Are you investing in or again, I'm sure it's a spectrum, or is it like private stock in a production company or special purpose entities? So what exactly is the, again, tangible asset that is typically structured for these types of projects?
So what happens, you come in, you'll be part of a group of individuals that puts a chunk of funding and become part of an LLC. So it throws off K1 income as the investment matures over time. Now, we are very, very particular because we kind of consider, even though that's also a strategy that is for tax benefits and tax mitigation, we also consider it a private equity investment. So, we have a program called the Due Diligence Project that has 146 data points that looks at everything that we invest in, possibly look at. So we know that there's a darn good chance that we're also going to get a return, not just a tax benefit from it. Kind of giving you a general idea too is we tend to kind of not do naked private equity or naked equity positions, only because the wealthiest of the wealthy focus on safety first. So like if we go into an equity position, and some of these, and keeping on the films a little bit, some of these productions do already have assets built up that can protect the investors should something go wrong, and they still would make a return or get their principal back. And that's kind of a thing that we have throughout the Hilton Network platform, that anything we do on a private equity basis, we're going to try to build in a component where there's plenty of assets. If let's say somebody invests $100,000, there's $500,000 in assets backing that up. So if they had to fire sell or anything, we're going to get paid back our principal, plus we're going to make our returns. But we still have great upside potential. So that's a little bit different, and the Hiltons can afford to do that. In the early days, they couldn't. Now they can afford to kind of demand that and say, hey, we want some really good surety associated with this. And even in our film projects, there's surety built in various areas that we've done the due diligence and know, hey, we're going to make money, and a lot of money, on the tax mitigation part of it. But we want to be almost assured that we have some resemblance to know that we're going to also make it something on the back end too.
Sure. So with at least to films, a lot of my experience, at least with, K1 pay through stuff is mainly based in real estate, where you have maybe, let's say, typically it's going to be about a 5-year runoff when you factor in things like cost segregation and accelerated depreciation on
Yes.
those types of
Right.
projects. But what is exactly, and again, this is, maybe a little bit technical, but I'm interested and I got the guy to ask the question.
Yeah.
So like, when it comes to what the actual
Keep in
pass
mind, I'm not a CPA. Okay, keep that in mind. So,
So again, speaking at a high level, what are typically going to be one? What is the claimed income? Is it going to be interest income? Is it going to be shareholder distributions? And then what are typically going to be the pass through write off? Like what is going to be like the attributable pass throughs that are typically seen in film projects?
so they're structured. Some of them are structured differently. And again, I probably said that at the right time. I'm not a CPA.
Mm-hmm.
And I'm not in that world, and I probably couldn't dive in and tell you exactly where things are
Sure.
going on the tax return and how they're done. I do know, because I invest myself in almost everything that we do, that generally we get K1s from projects like that or other similar types of projects. Honestly, I'm just being very straight. I don't know. I have my own CPA that handles it all, and we have 5 or 6 different tax returns. I don't know exactly physically how they handle the. I
Okay.
just know we get the benefits. I look
No,
at the
that's
high end and
Hey,
knowing.
and I much more appreciate the honest answer than one that is maybe based in some guesswork. So again,
Yeah,
certainly appreciate that. It's just that's the part of the investing world that I really it's when someone says that, most people when their forehead hits the table, I'm like, tell me more. um,
yeah.
so
I'm
yeah.
with what I do. I'm like the quarterback.
Mhm.
When I work with my clients, I'm the quarterback, and I get them hooked up with all the right people and make sure that everybody on the field are the exact right people to be on the team.
Yeah.
And then generally we have a CPA that we hook our clients up with. It's more of a proactive planning CPA as opposed to just a compliance CPA that kind of dives into all those things and then does handle the compliance work too, and on the back end to make sure everything's filed right and
Yeah.
all the strategies are accounted
Yeah.
for.
And this would probably be high enough level to where I'm sure you probably know the answer to this. But before we move on to maybe some other investments that are beneficial to the tax planning world, but what's kind of the typical like lifespan of a film investment? Because I turn on my Netflix and I can watch films from the 50s, and I'm sure someone's still making money on that. They're not doing it pro bono and putting it out there. Someone's still making money. But what's kind of a typical like start to finish? Again, to pick on commercial real estate, typically they're run on about a 5-year clock. If everything runs perfectly, granted with cap table compression and your how expensive money is getting. I think in 2025 we're going to see some real shifts in how the commercial real estate world is playing out with their strategies. But
Yeah.
again, on like an ideal scenario, what's typically kind of the runway for investing in films?
So it depends on where you come in funding into the project.
Mm-hmm.
Some films need funding right out of the gate. Some films get through partial production, but then they need more funding to finish production. Some films need funding on the back end for marketing purposes. So it kind of depends. If you were look at and then it depends on the production, how big it is, what's the scope of the production. If it's a small film that's say only a $20 million production, then the lifespan might be 3 years
Mm-hmm.
throughout the full so funding comes in, they begin production, then they have to, and the film world is very fascinating. I could probably do a whole podcast with you just on what I've learned, the little that I know, but what I've learned in the film industry and how it really works. So there's a film we've been involved in 2003 that we put multi millions into, that is literally in what they call post production, that
Mm-hmm.
probably should be released at the end of 2023. So then we'll start seeing income immediately coming in from that, not just all the tax mitigation benefits, which makes it worth it in itself, but we'll see income really quickly from that. So it just depends
Mm-hmm.
on what's available, the films available, and what our production companies have in the pipeline.
Yeah, and that makes perfect sense. The fact that, these things, it's with any type of business, and films are a business, the film industry, right?
Yep.
With any, there's capital requirements at every portion of that vertical, whether it's the initial production, getting things off the ground, going to, going to
Yeah.
market, everything. Again, it's very interesting because
It's the film. You're right. The film business. When I'm in con, the majority of time is going to be spent talking with different production companies, different funders, the financing side of things, which is 75% of the film festival.
Mhm.
What people see is, oh, they have the premieres and all the stars are out going down the red carpets and all that kind of stuff. That's a much smaller, really, portion of it. What's happening behind the scenes, literally behind the scenes, is massive, and the money that goes through that business is just unbelievable. It
Yeah.
really is.
I
So
mean, there's not for nothing when you see a film production that has, $500 million tacked behind it, and you see, it's again, each year there's billions of dollars worth of films released, not to say what's already in the pipeline for production. So,
yeah,
that doesn't just come out of the ether. There's,
yeah.
places and there's money to be made. I think you're right. I think this is very interesting, but to kind of
Yeah,
transition a
yeah.
little bit as
It's
well.
fun to talk about films and all of that because it really is an interesting industry. But it's just one area of area that we work in, and primarily we're mainly focused on the tax mitigation side. Yeah, we're going to make some returns, and if they go, we're going to make some pretty darn good returns on our money. But the reason we mainly have it in there is to take advantage of the 181 and Section 167 benefits that are afforded with it. So
Sure. Now, to transition to maybe in some other asset classes that can offer some great tax mitigation strategies and ideally some great returns as well. You mentioned oil and gas, and I think we kind of tailed
Mhm.
off a little bit. But just on a high level, what are some other ones that are kind of passion points for you, at least in the strategies that you
Yeah,
like
and
to
I'm talking
employ?
about some high level kind of one off ones. One of the ones we've used for years, and it's very simple. There's a code in the codes, private letter rulings, case law. We have the ability to purchase bulk minerals, different types of more rare minerals. A lot of the minerals that will go into batteries, things of that nature. And then the government gives us deductions when we purchase into those for that to go out into the open market. So then we can get generally a 4-to-1 in most of those offerings.
Mhm.
Like, for instance, last year it was volcanic ash. Well, volcanic ash is used in a lot of fertilizers, things of that nature, and it's a highly utilized substance around the world. So it's very it's not like uranium or something like that. It's not massively valuable, but in quantities it's needed.
Mhm.
So then we purchase in bulk, and then we sell to a charity that can then give us the charitable deductions that is all allowed within the codes. And again, without getting too in depth because there's other aspects to it, but that's just another example of a one-off type of thing. And it's very simple. You simply invest the money, you get your 4-to-1 deduction, and then you move on
Gotcha.
to the next year. So
And are those kind of investments, again, at a very high general level, are they typically done as some type of like LLC or limited partner investment that then in turn
yes,
pays back through some type of
absolutely. You're part of an LLC. And when we do these, we try to structure them and make them very simple because, again, we're not dealing with, and don't get me wrong, I mean, we have sometimes investors invest 10, 20, $30 million in these types of things. But we've also got investors that are investing 50 or 100 or whatever.
Mhm.
So we try to keep it simple so those folks can understand. It's very simple. They get K1s that come over on virtually almost everything. And so we try to deliberately structure that so it's just not too confusing to them or even their tax preparers.
Yeah, absolutely. And that's the nice thing about that portion of the tax code is that there's so many different nuanced and complicated things that you can do that can be certainly be beneficial. But when it boils down to some of these more, the private equity side and the private investments, a lot of it is not as complicated as people might make it seem. Granted, you need to be investing in something that's going to maximize your benefit, because investing in something that maybe has as long of a runoff as certain investments in a film vertical may not be as beneficial to you in the present as investing in commercial real estate or volcanic ash type thing. So I
Yeah,
think that's kind of
absolutely.
where I'd like people to understand the context of when we talk about private equities is that it's not a one size fits all. There are so many different variables that go into this, and that's a benefit to you.
Yes.
You lose a lot of that investing in the public stock markets. You basically have did you make money or did you lose money? Did you sell something or did you keep it for a year and a day?
Yes.
It's
Absolutely.
painfully simple, but it with that simplicity offers a very reduced cross section of benefit to people. Where you really start getting these benefits is when you can kind of step out of just the normal tunnel that we're all driving down and look at, hey, there's all these other roads you can go down. There's a beautiful scenic route you can take through this neighborhood. You can drive down the Pacific Coast Highway when it comes to your taxes, and really gather some of those benefits. Now, getting up a little bit towards the end of when my producer likes to package these up, again, I think we've covered a lot of great content, but I always like to make sure that we, when we have guests on, we really kind of make sure we at least ask the question, is there anything that you really want to get across to people that we haven't covered, because we have about 10 minutes left,
Yeah.
of things that you think would be really beneficial for people to hear.
So a couple things. Number one, yeah, we've talked a lot about taxes, but I mean, I think the biggest thing is just trying to figure out ways to have access, and a lot of your folks do, to some alternative assets, things like that, have access to those things to try to build wealth in a more efficient way. My next book that's coming out, Hilton Wealth, will talk about when you really look at the wealthiest of the wealthy. One of the big concepts that I teach people about, because most people are used to investing on the retail side of the business, and that is a totally different deal. The retail side of the business, what you hear all the time, it's about greed. It's about making money. It's about the 1, 3, 5, 10-year performance of a mutual fund. It's look what the stock market can do for you. Look what this stock can do for you, all of that. The wealthiest of the wealthy don't invest that way. And you've probably had some experience with this, Alex. There was a famous story when there were some hot shots on Wall Street years ago that invited Warren Buffett into a room with his folks, and they were making their clients tons of money. And they walked in the room, and this young guy gets up and starts touting all this stuff to Warren Buffett and saying, "We're going to make you this money. Look what we're going to do for Berkshire Hathaway," and all that. And he's a nice guy, but he got a little perturbed, and he said, "Young man, hold on. Have you read any of my books?" And the guy kind of like, "No, I haven't." And he said, "Does anybody in here know my number one rule to investing?" Not a single one of those guys could get it. And you've probably heard this before. It's common knowledge. He said, number one rule investing is don't lose money. And he said the number two rule of investing is look at rule number one. Okay. Mm-hmm. And we've heard that before. These guys, this was years ago. They'd never heard that. And they were like, oh. And he said, and they got up and left the room, and he said, when you can tell us how you can protect our money, then we'll come back and we'll have another meeting. And the point here is that the wealthiest of the wealthy are looking, the vast majority of their portfolios are mostly protected. But then they're after taking that percentage, they're after their returns and taking risk with a smaller percentage of their portfolio. They're not taking 100% of their money and putting it all in this high risk stuff. Occasionally you'll see that. You'll see a person drop off the Forbes 100 list or whatever, but that's pretty rare. Most of the time they're protecting their money first. They're on the institutional or the smart money side, so they are making the money that they need to make, and they're going to make the returns they need to be making. So they're concerned first and foremost about protecting their money. Mm-hmm. So that's a big deal, and what we educate our clients about, and that's what my next book is going to be really focusing on. Protect your money first, and then it doesn't mean you're not going to make great returns. You can still make 10, 12, 14% per year. You just have to be smart about it and not take the chance that you're going to lose 50 or 60 or 70% of your portfolio.
No, absolutely. And to the Warren Buffett point, there's a reason that Berkey is trading at over $600,000 a share this morning. So, protect your wealth.
Yes.
Protect your wealth. And that's a thing. I think it's a really good, point to end on, is that, wealth means a lot of different things to a lot of different people. Your wealth may be the $10,000 you've saved up over the past few years. It could be the $10 million you've saved up over a lifetime. But protecting that should be your first and foremost goal in life, and to grow it as well. But don't sacrifice one at the benefit of the other. Granted, there is some trade-off, but understanding that there is a balance to that, and understanding where you can protect it is going to be from, investment strategies, and certainly as tax strategies as being first and foremost, I think is kind of a good place, and two good points that you can really take from this conversation. So, with that said, I know you have some books coming out, and if people want to learn more, maybe get a copy of that. Is it on Amazon? How can they get in touch to kind of get some more information for, I'm sure, some fantastic information that's been written in those?
The easiest way is to go to hiltonwealth.com, hiltonwealth.com. There's a pop-up that will come up. You can order my most recent book, which is The Tax-Free Business Owner. And even if you're not a business owner, we'd be happy to send a copy to you, complimentary. And you're going to learn how taxes really work. I believe that our launch date is May 31st for Hilton Wealth. So keep an eye out on the website. We're doing some updates to the website too, and you'll be able to order that book coming up also. The books are designed to be short read books, because no one wants to read a book nowadays. But we also have them in PDF forms. You can listen audio versions of them on all of that. Hilton Wealth, I believe, is already a pre-bestseller on Amazon, but that'll come out. Everybody will see that very soon also. Okay.
Well, fantastic, Mark. Again, the most valuable asset we all have is our time, because it's the one thing we can't make any more of. No matter how good we are at investing, how good we are at mitigating taxes, we never get some more hours on the day. So thanks for carving out a little bit of time for us today. I really do appreciate it. Again, this has been another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.